Thank you. Good afternoon, everybody, and thank you to Johnny and to Brett and the team at Radley Elder for putting on today's seminar. And what I'd like to do over the next few minutes is just provide some insights into the integrated reporting journey over the last few years, which started as an idea around 5 or 6 years ago. And that idea centered on some of the criticisms that we're all familiar with around corporate reporting, that reporting had become too narrowly focused on financial transactions rather than real financial value, that reporting was done in silos within business and was often reported in that silo mentality, and that reporting had become unresponsive to the reality of business in the 21st century. It was being developed in a piecemeal way with evolutions such as sustainability reporting, value reporting, triple bottom line, lots of initiatives and innovation, lots of pioneers and innovators. But really the system of corporate reporting wasn't evolving to meet the needs of the 21st century. And reporting that was once popular, corporate reporting with in the 1930s and 40s, The Economist and the Financial Times and other global newspapers would often write editorials commending the innovation in corporate reporting by large companies in the UK and around the world. That sense of innovation and popularity around corporate reporting, that it could have a wider purpose beyond simply being transparent and producing some paper for use by stakeholders, that it had a wider purpose, has been lost over the years and has become a compliance exercise. And we've seen great examples today already, and I know you're among the pioneers and innovators where that compliance exercise has moved on towards communication. But what integrated reporting seeks to do is not just draw on the pioneers and inspire the pioneers, but to shift the system of corporate reporting so that the mainstream of reporting is about communication and not the exception. And so 5 years ago, the IIRC was formed, and at the same time, in the aftermath of apartheid in South Africa, a new inclusive stakeholder-driven model of corporate governance was being implemented in that country, and integrated reporting, and South Africa really is the cradle of integrated reporting, was adopted in South Africa. And today, on a comply or explain basis, Johannesburg Stock Exchange listed companies must produce an integrated report. So the IIRC is multi-stakeholder, brings together large businesses, investors, standard setters, regulators, and others from around the world. And its purpose and mission was to create the world's first integrated reporting framework that was developed and released in December 2013. And the framework is much more a management tool than it is a reporting tool. It comes back to one of the comments from the earlier speakers, which really you don't start with the process of a report. You start with the process of the integrated thinking and integrated management. And the framework really does start with that integrated thinking and the way an organization should be managed, with the report very much seen as the outcome and the output of that process. Integrated reporting, the movement, is market-led, not regulator-led. And so it really does put market participants back in control of the innovation of the system of corporate reporting. And the idea is that a concise communication about value can help an organization to talk about its strategy in a way that has a purpose and meaning for investors. And in that way, there is a great and close alignment with the strategic report here in the UK, which has been a great spur to integrated reporting being considered and now adopted by UK-listed companies. We're very clear that integrated reporting is not another reporting initiative. If anything, it is an umbrella that brings together in a cohesive way a lot of the initiatives that are already out there. And the focus is very much on bringing cohesion to the system of standards and frameworks to bring clarity to the market, because there is a great deal of, when we talk to businesses, a lot of confusion about which standards to follow in the financial reporting or sustainability reporting or in other forms of reporting. And there is a need now to bring greater cohesion and clarity to the market. So step one from the IIRC's perspective was to establish memoranda of understanding with the main reporting organizations in the world, the IASBs, the FASBs, the SASBs, the alphabet soup of the corporate reporting system, to bring alignment between what we are doing with integrated reporting and what they're doing with their specific standards and frameworks in their particular frame. And step two, about a year ago, was the creation of what we've called the Corporate Reporting Dialogue, which brings together all the main standard setting and regulatory bodies for corporate reporting around the world to produce a landscape map which maps the standards of corporate reporting and financial reporting and sustainability reporting principally against the 6 capitals, the resources and relationships in the International Integrated Reporting Framework. And that landscape map is now available on the IIRC's website, which helps to bring clarity and understanding to how those different standards and frameworks map to integrated reporting and the detail of the framework. So the IIRC's mission is focused on mainstreaming integrated thinking and reporting in the public and the private sectors. And our vision is that mainstream adoption of integrated reporting will contribute towards financial stability and sustainable development. And in terms of adoption, over 1,000 companies in the world today are adopting integrated reporting, and that includes companies in all parts of the world. I think there are now 25 or 26 countries in the world now, to a greater or lesser extent, starting to adopt integrated reporting. And you'll have seen in the mission that we talk about the public sector as well. The World Bank is leading an initiative that we've established for the public sector, which includes parts of the National Health Service in the UK. And even cities around the world are starting to look at integrated reporting as a way of understanding the resources and the way the city should communicate to its stakeholders. And Bristol City in particular is adopting integrated reporting as we speak. Now, one of the key concepts of integrated reporting is this idea of expressing value by reference to the 6 capitals. And these capitals are the resources and the relationships that are used by business to create value over time. And our view is that if a company is reporting on its strategy, it should have a clear understanding and be able to articulate what the resources are that that business has been able to draw upon to execute its strategy. Financial resources are critical in that consideration, but as the graph behind me illustrates, a business's dependence on purely financial resources and transactions for value creation has diminished over time. We now live in a knowledge economy where intellectual, human, and natural resources are more important today than the standard transactions that you would find in financial reporting. So for us, reporting should not just be around those financial transactions, but should be around financial value. And financial value is hidden in pockets through the chain of decision-making and activities of a business. The reporting system should be able to elicit these pockets of value and explain and articulate them. And Unilever is just one example that I will pick out of the air, because Jean-Marc Huet, the CFO of Unilever, said when he was asked why Unilever is starting on the journey to integrated reporting and what benefits Unilever had received from it, he said that through the process of integrated thinking and reporting, risks and opportunities had been spotted within the business that simply otherwise would not have been seen through a principle of connectivity of information, which I will talk about a little bit later. So we want to encourage and put reporting back on the side of encouraging not just short-term value creation, which is absolutely vital, but also medium and long-term value creation as well. And as we all know, and again is demonstrated by this graph, investor holding behaviour over the last 50 years has been moving in one direction, and that is to become shorter and shorter. And I think on average, 50 years ago, investors held shares for an average of about 7 years. Now it's less than 7 months. And the integrated reporting framework is a tool to help businesses to think about their strategy over a longer time horizon. And we think investors, if they're given this information about long-term strategy, it will help them to understand the bumps in the road along the way, for them to make it easier to understand the business and buy into the business over a longer period. And certainly this is backed up by recent research from the Harvard Business School that looked at over 1,000 businesses that were on the journey to integrated reporting in the US. And it showed that those companies that were on the journey towards integrated reporting attracted more dedicated long-term investors and actually deterred transient investors or traders, because those traders trade on information asymmetry that simply isn't there with integrated reporting, with a more complete set of information about value creation. And it was Mark Carney, the governor of the Bank of England, who said last year that if businesses and our economy wants to run an economic marathon rather than a series of sprints, then we must embed social capital into economic decision-making, not just rely on financial resources alone. Otherwise, we are destined, he said, to make a series of short sprints interspersed by economic decline. So what is the purpose and aim of integrated reporting? Well, I will just draw out one of those on the slide behind me, and it really is to bring about more efficient capital allocation. It was Adrian Cadbury over 20 years ago, 1992 in fact, who said that information is the lifeblood of capital markets. And the information needs of the market has changed since 1992, and our corporate reporting system needs to reflect that. Now, integrated reporting seeks to bring cohesion to the suite of information that companies provide to the market. And for those doing sustainability reporting or CSR reporting, it helps to streamline information and put it through the filter of what investors want from that information. Because we often, in shorthand, explain the difference between sustainability reporting and integrated reporting like this. We say that sustainability reporting is largely an exercise in transparency, where the business is trying to communicate its impact on the environment and on society, whereas integrated reporting is seeking to take that societal impact and reflect it back into the business. It's the business model and the strategy of the organization. So if you're Coca-Cola investing in Africa, then Africa, which has water shortages, you need to have as part of your strategy not just communicating that you are trying to reduce the impact of water, but you need to communicate how that is impacting on your business model, or the reuse, reduction, and recycling of water, so that that has meaning to investors, and that builds the confidence of investors as well. So integrated reporting isn't just a transparency tool, communicating your impact on society and the environment. It's about saying, how does that impact back on the business model and the strategy of your organization? Now, this diagram from our framework, which we affectionately call it the octopus diagram, explains some of the fundamental concepts behind integrated reporting. And there are three fundamental concepts: the business model, the capitals, which I've talked about, and value creation. And what businesses are finding most useful about using integrated reporting is really seeing how the capitals are transformed by the business model. And it also helps to extend the disclosure horizon, which is a really critical point about integrated reporting, because at the moment, companies are often asked to report on historic information and a little bit of future-oriented information. Whereas what integrated reporting does, by marrying it to the strategy and the business model of the organization, is that it invites a company to consider reporting over a longer time period, over the business cycle or over the strategic period of the organization. So it enables an organization to really understand and communicate the trade-offs that businesses are making every day in their life. So, for example, a business that wants to improve the productivity of its workforce by investing in training will do so by investing financial capital in human capital. So it will reduce its financial capital in the short term with the intent of increasing the value of its human capital in the medium and the long term. And hopefully, if it's been successful and productivity is increased, as a result of that investment, financial capital in the long term will go up. The value of that financial capital will go up as well. But it's all about the time horizon, because if you're only reporting at the moment that you make that financial investment, then all you will see is a reduction in financial capital. And if you're only reporting on the financial transactions, how does an investor or other stakeholder know that you're making that productive investment? So integrated reporting is about understanding and being able to articulate those trade-offs between the decisions that are made and the resources of an organization, and over a longer time horizon. And it's also important to note that integrated reporting is not a compliance mechanism. It's a principles-based framework to guide decision-making. And in a UK context, we are finding businesses now referring to the framework, as well as the FRC guidance on the strategic report, and there's conceptual consistency between the two. One, of course, is legislation and a requirement, and the other, integrated reporting, is international best practice on a voluntary basis. And it's a demonstration, really, of how the market and regulators can work together on an initiative around aligned objectives. Now, I'm not going to go through in detail the guiding principles and the content elements that are in our framework, but I would just draw out 2 points from the guiding principles which really guide an organisation in preparing an integrated report. The first is the principle of connectivity, because it isn't enough, in our view, simply to report against each of the capitals, financial, manufactured, and so on, but it's important really to recognise that they are interconnected. And to be able to demonstrate that connectivity, we use that connectivity to break down silos within the organisation. And judgment is also important here, because you'll see that 2 of the principles are conciseness and comparability and completeness. So really you need to exercise judgment within the business on how to make the balance between providing a concise articulation of value and yet providing complete information. And the content elements guide the preparation of the report in a very detailed way. Now, it's very important to us that this has purchase within the investment community. Are they on side with this development in the system of corporate reporting? Well, there have been numerous surveys, but I've just shown a slide from one survey from PwC of mainstream investors, which shows that the investment community find that the information contained in an integrated report does have a direct impact on the cost of capital. And in that same survey, over 60% of the investors said that the quality of a company's reporting was a useful signal to indicate the quality of a company's management. And so we are seeing an increasing interest from investors in the quality of corporate reporting. So long-termism, financial stability, and sustainable development, these cannot be achieved, obviously, by corporate reporting alone. It's part of a much bigger ecosystem. And so the IIRC has started to articulate what integrated reporting means in the context of some of the big economic developments that are happening in the world. And so what we're calling for, and what we think is absolutely essential if integrated reporting is to become mainstream practice, are some shifts in the way we think about the economic system and also our capital markets. And so we want to see a shift in thinking and in policy terms from financial capitalism to more inclusive capitalism, from short-term thinking within capital markets to long-term thinking, and that will enable a shift from silo reporting to integrated reporting. And so in this context, we back initiatives like stewardship codes, which recognise the responsibilities of investors to understand the business that they invest in, and it drives stronger and more meaningful discussions between boards and investors. Now, very briefly, in the last couple of minutes, I just want to run through just a few examples with you, because often people say, yes, but what does it look like? What does it mean in practice? And I'm not going to do justice to these examples, but each of these examples and many more are on a database of examples which can be found on the IIRC's website, which I would encourage you to visit. But this is an extract from the Go Ahead Group's annual report, and it shows really the organisational overview of Go Ahead Group. And what it does really, over 2 pages in the annual report, it gives an awful lot of information, connected information about the organisation's strategy, its financial performance, its values, how the organisation is governed. So this is just a concise picture of the organisation in a very, very clear way. In terms of corporate governance, this is an extract from Marks & Spencer's annual report, which really shows the quality, in a qualitative way, what the board of directors has been discussing. Again, the governance, the strategy of the organisation, and some real detail. Because what we say about an integrated report is that it should be the compelling voice of the board. Now, if you don't understand in qualitative terms what the board has been discussing, it's very difficult for that report to be that compelling voice. And so this is just one way that Marks & Spencer has been able to articulate that point. On performance, this is an Australian company, Stockland, and what this shows, again, very, very clearly and concisely, is not only the past performance, but how that connects today into the future, and today, and also giving some information about what the plans are for the future, because future orientation, being able to articulate what your plans are for the future, is a key aspect of integrated reporting. And then finally, from Arm Holdings, this is just a demonstration that it is possible within the context of a corporate report to give industry trends about the future and relate that back to the business, so that you're being more future-oriented, that you're giving information about the future of your industry and linking that back to the strategic decisions that you're making as a business. And so I would encourage you finally to visit our website, to read the framework if you haven't already, look at the examples and case studies, and get in touch with us. For those companies that are on the journey to integrated reporting, you're very much not alone, either in the UK or globally. And we do, as the IIRC, have a business network in the UK and an international network, along with different sector groups that are exploring how the principles of integrated reporting can be adopted consistent with the needs of your particular industry or sector. So we would obviously welcome your participation in those groups. And my final point really is just to come back to a bigger point that was raised by Klaus Schwab, who is the chairman of the World Economic Forum. And he said in the Global Risks Report that the World Economic Forum published this year, that increasingly we live in an interconnected economy. And there isn't enough just to recognize that we need new tools and new systems for being able to understand and articulate that interconnected nature of our economy. And with the framework that we've developed, we do hope that we're making a contribution that supports business and investor decision-making and that brings greater cohesion to the system of corporate reporting, aligned to regulatory initiatives such as the strategic report, which is becoming standard practice here in the UK. Thank you.